U.S. stock market got hit hard today as the S&P 500 suffered its worst day since May 12th. In fact, this was only the fifth day in the last year where we've had at least a 2% pullback. This was a day that was dominated by the bears, where 89% of all stocks closed in the red here today. A lot of it was as a result of worries around the coronavirus, some concern about surging interest rates, and the possibility of the Fed starting their tapering of their government bond buying program. So we'll see what that means for the markets, and then we'll get into the trade application example here today, where just like a week ago when we had another big sell-off, I wanted to take advantage of that higher implied volatility by selling a put on what I perceive to be a fairly high-quality company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 28th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and sign up for our email distribution list within our description area. That'll entitle you to the notifications that we send out regarding these videos, and then also give you a heads up on what stocks are giving you oversold and overbought cluster signals within the S&P 500. And on a big down day like today, I imagine there's a ton of oversold cluster signals out there, so make sure you stay tuned to our emails for that. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me if you're not doing so already. We really appreciate those of you that click like and retweet on these Market Outlook related posts. That helps us get the word out about our organization a little bit more and helps ensure that we can do these videos for you for free as often as possible. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at the web address you see listed in the logo in front of you. All right, let's jump into today's trade activity. And anytime we have a big day, I try to start off with chart 6D here for those of you that are premium market scholars following along at home on your own charting package. And this particular chart will basically give us a sense as to how big of a day we had compared to either recent history or perhaps going further back in time, just to give us some better context and perspective as to whether these days are normal or whether we should all be, pulling our hair out. And of course, I think you know the answer to that. These days are fairly normal. These are not uncommon types of days. Is it a little bit painful along the way? Of course it is. As I was mentioning to you last week, and those of you that follow me on Twitter know that I had posted this on, I think it was September 3rd. I said, whenever we get a pullback in the market in the future, and I had no idea it was going to come within the next couple of weeks, but I had a feeling that whenever we did get that, the rookies of the market out there would really be struggling. And it's not anything that they're doing wrong. It's simply because they've been trained and conditioned by this market to not expect major pullbacks along the way. Remember, we just got done going up for 7 or 8 months in a row on the S&P 500. That's something that's only happened 5 times since I've been trading in over 2 decades. And so that is the more abnormal part of what has happened in 2021. Not what has happened in September, but what happened prior to September. The consistency of the up move was the abnormal part. What we're experiencing right now with some of this profit taking is perfectly normal behavior. And so finally that monthly streak is likely going to come to an end here as we close out September in a couple of days. So here's how things look on this chart 6D, where this red bar right here will signify how big of a day it was. And it was a big day. I don't want to discount it, but at the same time, I don't want to make it seem like this is completely unheard of. To show you kind of what has happened in the last year, you can see that today this red line touched this orange horizontal line, and as you can see here with the labels, that orange line represents the 2% mark. So if it's a red bar going to the orange line, that's a 2% down move. If it's ever a green bar going up to the orange level like it was over here, that means it was a 2% up move. The black line in the middle is kind of your starting point at a 0% move. So today's move was uglier than what we experienced a week ago, when we also had a pretty ugly day that was down over 1%, but this one even surpassed 2% here today. Just barely. It was down 2.04%. So just a hair over a 2% sell-off here today. And as you can kind of see, as you look towards the left a bit on my chart, the last time we had a 2% sell-off day was back here on May 12th. Now, unless you've got a pretty good memory, most of you probably don't even remember what the specific reason behind the 2% sell-off was on May 12th. And I would suggest that 6 months from right now, maybe a year from right now, people will look back at this day and say, boy, that was sure an ugly day in the market, yet they will not be able to remember why the market sold off that day. In other words, these are effectively non-events. These are profit-taking opportunities after a stock market has gotten a little bit ahead of itself in terms of valuations. Remember, the current valuations are effectively about the second most expensive stock market in history after the dot-com bubble. So these types of days should not be necessarily feared. They are part of the entrance fee to come into this game known as the stock market. Obviously, markets don't rise every day. You've got to earn your keep, so to speak, and how you do that is through taking some lumps every so often on days like today. Now, prior to May 12th, we also had a 2% sell-off day back here on February 25th. Again, I don't remember the specific reason for that one, just like folks probably won't remember today. And also back here on January 26th. That was actually more aggressive than what we saw today. That particular day, we were down 2.5%. And then last but not least, if we were to go back to about a year ago, it was back here on October 28th of 2020, where we had more than a 3% pullback. Notice that this red line right here is crossing down and through this pink horizontal line, which represents the 3% move area. And so within the last year, that was by far and away the worst day that we had. But of course, that's on a rolling 12-month basis. Those of you that traded through the coronavirus era will know that if you went to a 2-year chart of this on a daily candle, that we had some really hairy days here back in March and April of 2020. But again, if we were to go to just the 1-year rolling period, that doesn't include that, then last October would have been the biggest down day that we have suffered here in the past year. And so keep in mind that right now we are on track from a monthly perspective to have our worst month since that time that I'm pointing at back here in October. In fact, I haven't tried this before, but I assume it'll work. Give me a second here. I hope I don't end up with egg on my face, but I think what I'm going to try is I'm going to, instead of changing the time interval like I did a moment ago to 2 years, I'm going to leave this at 1 year, and instead of doing the aggregation period of day, let's do the aggregation period of month, and you can kind of see that highlighted a little bit more obviously here. In fact, as it stands right now, from what I can tell, this appears to be even worse than what we suffered back in October. So I think I heard that on CNBC earlier today, but perhaps that was not including today's move. But as far as I can tell right now, it appears that our current month of September is basically the worst one that we have suffered in the last year. And here's what I was referencing before about kind of one of those record-setting moments throughout much of 2021 where we had 1, 2, 3, 4, 5, 6, 7 straight up months, which is very rare. 5 times in 20 years that's happened. So to have that monumental boil higher for 7 straight consistent months, I think a little bit of profit taking here to give back some of those gains along the way is somewhat warranted. You can kind of see up above here what those price candles look like on a monthly basis. And you can see that, yes, this monthly candle up here looks pretty ugly. It's the first red candle up there since basically back here at the start of the year, but we have only given back 1 month's worth of gains here at this point. In a way, that might feel a little scary, like, hey, it feels like we've kind of done some damage here in the month of September, but in all honesty, we're just trading back to where we were back here at the end of July. So this has not been damaging, and I think the point that we need to stress is what we've gone through here in September might feel uncomfortable, particularly to those of you that are new, but it can definitely get a lot worse. So you got to brace yourself. Then again, the economy seems to be reasonably strong. We do have some signs of inflation out there. We do see rising interest rates perhaps affecting things. And we certainly are starting to see some of the energy and metals starting to climb, which could put even further pressure on inflation. But right now, profits are still coming in reasonably well considering the circumstances of the coronavirus. And so all else being equal, I'd have to assume that in an environment like that, stocks have an easier pathway higher than lower. However, just like we've been mentioning over the past month or so, this is a seasonably weak time of year. September and October are notorious for stock market crashes, which makes a lot of people kind of walk on eggshells during months like this. But I have no reason to believe right now that we can't get back to all-time highs by the end of the year when we get into the traditionally stronger months of November and December. Part of it is just how much damage is going to be done in the month of October. So we'll all find that out together. But I think the whole point of this is to take a move like we suffered here today and in the month of September in stride and remember where we came from and remember that indeed there is risk in the stock market and there's nothing inherently wrong with that. That is what we need to pay in order to earn the types of rewards that are available traditionally in the stock market compared to other asset classes that traditionally don't have as good of rewards that are available to investors. While we're over here, let's also talk about kind of market breadth here today. So we know that the stock market was down 2%. But if I come over here to the Market Watch tab and pull up the visualize area on the S&P 500, you can kind of see here how big of a down day it was. And it was a pretty nasty one. 89% of all components in the S&P 500 were lower here today. In other words, 446 out of 500 ended up in the red. So there was a mere 54 that managed their way into the green. One that I did notice that was in the green was Clorox. And for those of you that watched my presentation a week ago, remember I wasn't with you on Thursday. I had some other things going on. But I was with you 1 week ago on Tuesday, and we did do a bullish trade on Clorox. So I was moderately happy to see that. Obviously, that doesn't do a whole lot to offset a lot of the other damage that is done out there, but at least having a few things working to your advantage, like Clorox being up over 1% on a day when the stock market was clobbered over 2%, is at least something that you can hang your hat on a little bit there. So some of those more mundane areas of the market, like consumer staples, probably held up a bit better here today than some of the more aggressive areas of the market, especially like technology. I did notice that energy did quite well today as well. Here is ConocoPhillips as an example. It was up over 1% today as well. So energy, maybe some of those consumer staples, they tend to hold up a little bit better on days like today where we saw interest rates surging and the rest of the stock market really taking a hit. Technology and communication services really struggled today and were consistently in the red across the board. Another way to kind of visualize this is looking at the heat map. I shared this on Twitter earlier today as well. At that time, it was 85% of the market was in the red. By the time that the market closed, it was actually 89%. So it worsened as we got closer to the closing bell. And here is what the S&P 500 looks like on the heat map today. You can see it was a sea of red. Some really aggressive sell-offs from stocks like Moderna. Some of those biotech stocks got annihilated here today. We've got some big CRISPR news coming out tomorrow with Editas with their release of their data on their form of blindness that they're trying to cure. And so that stock was down aggressively today in anticipation of that news and sent a lot of those other biotech stocks and other CRISPR stocks lower as well. So remember, Moderna was the talk of the town all summer long. Part of the reason Editas went up so much along the way was because Moderna was also going up, and Moderna came out and said that they wanted to kind of buy their way into the CRISPR space. So that created a bit of a feeding frenzy there, but you can see what the reverse looks like now as well. There is risk out there, right? Those CRISPR stocks don't have any commercialized products. They are highly, highly speculative instruments, and so while times are good, they can earn you some alpha on the upside, but when times are bad, they can hurt you on the downside as well. They are highly speculative. They are not Johnson & Johnson. You can see here that of the healthcare companies, Johnson & Johnson fared a little bit better. It was basically break even today. You also saw some really strong sell-offs in the technology area. There's Applied Materials down almost 7% here today. You saw AMD as one of those chip stocks down 6% today. ServiceNow was down nearly 6%. NVIDIA was down over 4%. Microsoft and Adobe and PayPal, they all got blasted here today as well. If you're looking for signs of life out there in terms of green market action, Again, I will stress that it was the energy patch that did have some positive vibes today. Conoco finished up over 1%. Chevron was higher on the day. Exxon was up over 1% on the day as well. And then a handful of those consumer staples names like Kimberly-Clark was up today. Clorox was up today. Church & Dwight was up today. Tyson Food was up today. Hormel was up today. So again, really old school types of companies there that market participants oftentimes drift towards in the event of market chaos, which is what seemingly we had today with a 2% pullback across the board. Let's go ahead and take a look at our traditional 4-grid now, and this will be chart 4B for those of you following along at home. And you can see the damage that was done here today. Look at all those red candles. There's the S&P 500 down 2.04%. There's the Dow Jones Industrial Average down 1.63%. There's the NASDAQ Composite. That was the worst performer of the day, down 2.83%. Again, those big names that I just rattled off a moment ago, your Adobes and your Microsofts, all of those are big components within the NASDAQ Composite. So tech had been a leadership area for much of 2021, but that might be slowly changing here right before our eyes. Remember, there isn't a component of interest rate sensitivity that comes into the technology stocks. Typically, if interest rates are surging, as they have been this week, that pressures a lot of the tech stocks that oftentimes have to have their cash flows discounted a number of years or perhaps even decades, because a lot of times with those growth stocks, some of them might not even be profitable today. So that's an area that you'll want to be on the lookout for if you expect interest rates to continue to go up going forward. Tech stocks could continue to get hit. And then over here on the Russell 2000, we did see a big sell-off here as well, 2.25% sell-off there on the Russell 2000. However, if you look at these 4 charts, we actually have some distinguishing elements, and that is that the 2 charts on the left, the S&P 500 and the NASDAQ Composite, both have a dark pink shaded background now, and both have a red moving average. The red moving average suggests price is below a falling moving average. That was not the case yesterday with the NASDAQ because it was still going up, but today's pullback on the NASDAQ was strong enough to actually bend the 30-day moving average lower. The S&P 500 has had a red moving average for much of the last couple of weeks, so kind of status quo there. But what is new for both of them today is that dark pink background color, whereas yesterday we had a bullish intermediate posture according to the market forecast technical indicator. Today we're back to strongly bearish on both of those as they both sold off pretty hard. Now notice over here on the right hand side it's a bit different. With the Dow Jones Industrial Average, we actually still have a weekly bullish posture. It's not strongly bullish because it hasn't crossed the 50th percentile yet. It's still at 48 on the intermediate line, but it is perhaps a more promising sign. Remember, about 3 or 4 weeks ago, it was very obvious that the Dow Jones was suffering the brunt of the malaise that kind of started off September, where we saw day after day after day those mega cap companies getting hit. And meanwhile, some of the tech stocks were still doing reasonably well. Now here in the last week or so, things have reversed course in a big way. The Dow Jones Industrial Average, which is chocked full of not just some of the consumer staples companies like Coca-Cola and Procter & Gamble, but also has some exposure to oil companies like Chevron. It's held up a little bit better in this move. I'll also add that financials have held up a little bit better here recently. So that's kind of helped through JP Morgan and Goldman Sachs and the like. But it's kind of interesting that it feels to me that like there's been a little bit of a handoff of the baton here recently. 3 weeks ago, we would have said the Dow Jones was our laggard and the NASDAQ was our leader. With the interest rate surge that we've just witnessed here in the last week, that has turned everything on its head. Now, the Dow Jones actually looks a little bit better than the NASDAQ Composite due to some of that interest rate sensitivity. You can also see over here that the Russell 2000 has a dark green background color, which suggests we have a strongly bullish posture there. However, this still appears to be a sideways chart to me. So I still have our bear call spread going on IWM for the small caps there as a little bit of a bearish trade, and I'm not particularly concerned about it at this moment in time, despite that green background color that we see there, because I still view this as kind of a directionless chart. It's more sideways than anything. So when we're selling bear call spreads, we can put up with sideways behavior. And so right now, be aware that we do have a strongly bullish posture combined with red line in the lower reversal zone. Many of you are aware that signifies a bullish intermediate confirmation signal. And then we have a couple of ways to distinguish whether those are better setups or not. And in this case, we would not say it's an ideal setup for the reason that the red line is at an extreme reading. We think of an extreme reading on the red line as anything below 5. You can see right here on the label it's at 3 right now. So that could give us an impression that there is going to be a posture change sooner than later if that keeps getting pressured on a momentum basis or a shorter term basis. The blue line is actually positioned at a pretty good level there. We like to see the blue line between 20 and 50 on that bullish intermediate confirmation signal, and we do have that at 43. So that's not the issue in this case. It's the red line that is the problem here. But this has been a pretty healthy pullback, right? For a lot of you, when you hear us discuss the bullish intermediate confirmation signal, we're just interpreting the signal and letting you know about it. But some of you might not always agree that it's actually a buy the dip signal, because a lot of times the market might have only sold off 0.5% or something along those lines. This is actually a pretty legitimate sell-off. So, for those of you that are looking to buy the dips, a 2.25% move in a single day is a decent dip to be buying if you're willing to kind of go into those muddier waters. I say muddier because, obviously half the market is bearish right now, the S&P 500 and the NASDAQ composite. And for a lot of people, those are the more important areas because they're market cap weighted, with the big boys kind of leading the way in the weighting. So you'd have to be a little bit more aggressive with your mindset to be taking bullish trades in the small caps at a time when the large caps are getting whomped like they are. Now, if things change in the coming weeks, maybe your mindset changes there, but just know that that would be a fairly aggressive counter trend mindset there, given what we've seen happen so far in the month of September. And by the way, the end of September traditionally is bad, so we already know that September is not a great month to begin with, but the end of September is traditionally pretty bad. According to the Stock Traders Almanac, the S&P 500 has been down 15 out of the last 23 years on the final day of September, which will be on Thursday here. So just be aware of that, seasonality statistic as well that could somewhat negatively impact stocks here in the coming days. So let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this particular project. Remember, David and I do this for free and on a volunteer basis, and so we would request that you guys do your best to try to support the project there, and the way that you can best do that is by clicking like for us there on Twitter. When you do that, it helps share this content with other people that's in your social circle, and if you're retweeting, even better. So I appreciate the 27 people that did the retweet when I did the video a week ago, and I really appreciate the 117 of you that clicked like there for us. It goes a long way to help it make it worth our while and justify the time required to do these videos on a daily basis. So if you want to see us do these videos for free every single day, then the one thing we ask out of you is just simply click like. That'll help send the message that we should continue to do that. So thank you very much to all 117 of you, including Tom and Jeanette and Dennis and New HQ and Austin and Braun and Fun, Jonesy and Following the Sun and Claire and Catherine and Prickly Trader and Kirk and Keith and Ron and Paul and Ken, Valerie, Adam, all the rest. Too many names to go through there, but we see y'all when you're clicking the like button. We do appreciate you. So please keep that effort up on your end, and we'll do our best to keep our effort up on our end as well. While we're over here on the internet, also should mention, we had our normal classes today, so I taught my dividend growth investing class. So for those of you that like the idea of trying to sort through the rubble on a day like today and scoop up the babies out of the bathwater, of course you're going to be more interested in my dividend growth investing class, where we aim to do just that. So that recording is posted here on our Trading Rooms calendar for those of you that are premium and plus members. And then David taught his directional option strategies class here today as well. Tomorrow morning I've got my factor-based swing trading class first thing in the morning, and then David will be teaching his inventory trading class in the afternoon. So lots of great content, as always, coming to you for those of you that are our premium members out there on a daily basis. You can see here I've got the sector selector pulled up. A reminder that this actually gets done on Friday evening, so it's a little bit stale at this point, a couple of days old, but generally gives us a pretty good sense as to what has been happening in recent weeks and months with sector rotation. As you can see, we still had healthcare and information technology up at the top as of Friday night. But one thing I found interesting is that energy did continue to climb last week. And judging by what I've seen in the first 2 days this week, I will not be surprised at all if energy replaces healthcare and technology up at the top. Now, obviously, we're only at Tuesday, and things could change dramatically Wednesday, Thursday, and Friday. But judging by what I've seen right now, what I'm kind of expecting in my head is that we get a push higher in energy up the rankings and also in financials, and that would push healthcare and information technology a bit lower. I also am kind of expecting communication services to maybe fall in the rankings, and perhaps consumer staples to maybe move up a ranking or two. And again, that can change, but that's kind of where my mind is at right now, a couple of days into this week of trading. All right, let's get back on over here to our charts, and let's do some 12 grid analysis, starting with chart 5A. This is where we're going to look at that interest rate surge that I had mentioned previously. Take a look at this chart in the lower right-hand corner. This is kind of driving trading right now. Notice that TNX is just going up day after day after day, and we're basically now at 3-month highs. Right? As of yesterday, we couldn't have made that claim. We were a little bit below where we were trading 3 months ago, but as of today, with a continued surge higher, we are now at 3-month highs on the 10-year U.S. government bond yield. So this has been an impressive move. Just a week ago, we were sitting down here at the moving average, and then boom, just like a meteor, this thing just shot higher. So that has an impact on a lot of other entities out there. I already mentioned the impact that it's had on technology stocks, the negative impact on those growth stocks and technology stocks. But remember, it also has an impact on some of the other sectors, like financials tend to do a little bit better, all else being equal, if interest rates are rising, because those banks, brokers, insurance companies tend to have a little bit better net interest margin in that environment. And then on the flip side, we oftentimes see that REITs and utilities struggle in that environment. Now, we also see that REITs and utilities can sometimes benefit when there's chaos in the air. So sometimes there's offsetting, situations there to a degree. But in general, if you're kind of thinking in high-level terms, be aware that if you expect interest rates to continue to surge, then that might be an opportunity to be looking for those financial stocks that are out there and maybe stay away from the REITs, the utilities, and the technology stocks. In this particular case, with the big surge that we've had, you can see that the TNX, or the 10-year Treasury yield, ended today at 1.53%, which of course is still pretty low on a historical basis. It's just that it's at 3-month highs here all of the sudden. And one of the effects that you oftentimes see is that when interest rates go up here in the United States, from a currency perspective, the US dollar goes up to reflect that, right? Because if money is always searching for the highest interest rates around the world, also considering the risk that it's taking, the US dollar is perceived to be one of the strongest currencies out there, or at least one of the most stable currencies out there. So risk isn't as big of an issue with the US dollar. And so if all of a sudden you're getting paid more in treasury yields, and let's say you're a Japanese investor, you have the decision to go either into, let's say, Germany or the United States into government bonds to be able to earn a higher rate of interest, then the interest rates here in the United States might be welcoming in more foreign capital here all of a sudden as a result of that interest rate surge. So notice the US dollar was up yet again here today, and it is also at 3-month highs, just like the 10-year Treasury yield is. Both of them have strongly bullish background colors there, suggesting that we have those strongly bullish postures according to the market forecast technical indicator. You can also see that oil joins them with the strongly bullish color. Oil actually sold off a bit at the end of the day, but like the other two, we've had a big surge in just the last week here in oil, and that has helped stabilize those oil companies that I've mentioned before, like ConocoPhillips and like Chevron and Exxon and the like. So that's been an area that seems to be working here more recently. We actually talked about a commodity ETF yesterday in my top-down trend trading class. Some of you that might not have attended that class for a while might be interested to learn that we have a new rule that we are implementing there that opens up the door for us to look at some of those ETFs in addition to the common stocks that we oftentimes would look at. So yesterday we did look at a commodity-based ETF, and many of them are surging pretty nicely and trending higher with higher highs and higher lows here more recently. Gold's a little bit of a different story. You'll see here that gold actually fell, and we're back to multi-week, probably multi-month lows here. We haven't quite passed the lows here that we set in the middle of August, but other than that one time right there, gold is basically at 3-month lows here. You can see we have a dark red background color telling us that we have a strongly bearish posture here. We have a red moving average price below a falling moving average. Remember, I do have an iron condor going on gold right now, so this one's a little bit more concerning to me because we might be starting to press the limits there on the put side of the iron condor. So I'm going to keep that on a shorter leash here, but I'm hoping that we have some stabilization in gold around this level where we bounced last time in August. And if that's the case, then our trade can still do reasonably well. But it's not looking so hot here for gold all of a sudden. Remember, a lot of times when the US dollar strengthens, gold struggles on a relative basis. Sometimes you see that with oil as well, but each commodity kind of has its own dynamics and own supply and demand that it needs to contend with depending upon different news stories and mine closures or oil well disruptions or pipeline disruptions or what have you. So there's a lot that goes into it, but high level, a lot of times what we do see is that when we have the US dollar going up, gold would struggle on a relative basis, and we are witnessing that here right now. The bonds, as I mentioned before, down across the board. We do have an oversold cluster on foreign bonds right now. I was a little surprised to see that high yield, aka junk bonds, struggled as much as they have this week. They really started to turn into bonds, which I know that sounds funny because of course they are bonds. They don't need to turn into them. But the point that I'm trying to make is what we had been seeing a lot this year is that high yield bonds had been reflecting interest in oil prices more than interest in bond prices. In other words, they kind of are a blended instrument that did better when oil prices were up and really kind of just disregarded movements in other types of bonds like long-term treasuries and foreign bonds. Well, all of a sudden, that's not the case here, right now. Whether it gets to be the case again in the future, we'll find out together. But I did want to point that out because it's acting a little bit peculiar compared to the way it had been acting earlier in 2021, and maybe that's an opportunity. Maybe people have gotten a little bit too crazy this week with interest rates going up and they're just selling all bonds regardless, and they kind of forgot about that correlation with oil prices. And if you expect oil prices to continue to go higher, then I would expect that high yield, aka junk bonds, would outperform foreign bonds and long-term treasury bonds as well. So keep your eye on that possibility there. Should also point out that preferred stocks got crushed today. Now that's only a 1% move, so that doesn't sound like much, but if you look at the chart of the preferred stocks, you can see that today's candle was by far and away the ugliest on the board there. So this is an entity that doesn't move around with a whole lot of volatility, and so not only did we have the worst one-day candle in 3 months here for preferred stocks, but we also crashed straight through that potential support area back in mid-July. So from a technical perspective, it's not looking very good there. Strongly bearish posture according to the market forecast, and red moving average as well. You can see as far as the stocks out there. Mentioned the U.S. was already down 2%. EFA, the developed foreign world, was down over 2% today as well. Surprisingly, emerging markets actually held up better. They were only down 1.29%. That's still a bad day, but on a comparative basis, they did outperform today. And you got to start somewhere because remember, emerging markets had been struggling for many months. And so maybe they're going to have a little bit of benefit here if we see some rotation within the market. Remember, a lot of emerging markets countries out there do have a strong presence in commodities. And so if we do see oil prices continuing to surge, then maybe some of those areas in the Middle East will start supporting EEM a little bit more. Of course, the big story there is and continues to be China, but it doesn't hurt if you have some supporting actors out there, and maybe we saw a little bit of that playing through today. So EEM, strangely enough, does have a weekly bullish posture right now. Let's take a look at our sectors 12 grid now. This will be chart 5C. And as you can see here, we actually have the middle rung of our sectors still in the green, despite the selling that we witnessed here today. Now, as I mentioned before, energy, the chart all the way off to the right-hand side here, that one makes perfect sense because energy was actually up today. That's kind of unbelievable to think about. You know, on a day when the market at large sells off 2%, to have one sector that was actually higher in that is impressive, particularly a cyclical one like energy. Now keep in mind, energy is a bit of an afterthought these days to the market at large if you're thinking about it through the traditional market cap weighted approach. I think energy represents like less than 6% of the market cap weighted S&P 500 these days. So when it goes up, you might think to yourself, well, good, that's going to offset some of these other sectors and help balance things out in the S&P 500. The problem is they have such a low exposure that even when they're up on a day like today, it's basically a non-event for the rest of the market. What really drives the market these days is technology and communications, because that's where you got your big FANG stocks, right? You've got your Apples of the world and also Microsofts of the world, the $2 trillion companies in technology, and then you've got your Google / Alphabets of the world and Facebooks of the world in communications. So those two, from a market cap perspective, are the most influential sectors that are out there. So on a day when energy was up, it certainly did not offset communications and technology. 2 decades ago, maybe that would have happened when, Chevron and Exxon were the beasts of the world, and, a lot of these tech stocks and communications companies were afterthoughts if they even existed. But that's not the case today. Today, we are in the land of the technological giants, and they dictate price behavior for market cap weighted indices like the S&P 500. So anyway, difficult day for the S&P 500, down over 2% because communications was down 2.4% and technology was down basically 3% here today and overwhelmed any of the other sectors that are out there. In terms of the other charts kind of here that are catching my eye, I would point out that financials outperformed today. That's the chart on the top that also has that dark green background color. Remember what I mentioned before. We've seen interest rates surging in the last week. That tends to benefit financials. It tends to disadvantage technology, utilities, and real estate. And you can see all of those areas are getting punched in the gut right now. In fact, it's so bad with utilities and real estate that we're actually putting in our third straight day of oversold cluster signals. So while they outperformed today by being down less than 2%, a lot of that is because they have already been down so substantially. What we're witnessing right now, by the way, in utilities may not have ever happened before. I'd be curious on the statistics on that. What I'm referencing is take a look at how many days in a row the utilities have been down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 straight days. Remember, that's more than 2 weeks because there's only 5 trading days in a week, and we've had a holiday with, Labor Day here along the way to think about as well. But 14 straight trading days, utilities have been down. Remember, they used to call utilities the stocks for widows and orphans, meaning that they're reasonably safe. Well, they are reasonably safe compared to other more speculative areas. I'm not going to take that away from them, but without a doubt, you can still get hurt in them. Now, what we're doing is we're looking for opportunities there. We are looking for opportunities by actually buying utility companies in my dividend growth investing class here earlier today because of this. we're not avoiding it because of the 14-day sell-off. That's exactly what attracts us to that merchandise, right? Because our mindset as dividend growth investors is we are looking to pick up babies that have been thrown out with the bathwater. Those of you that are more trader-oriented as opposed to investor-oriented, this is an area that you're probably avoiding right now until it can find some stabilization. For others of you that are looking for high-quality companies that have long histories of dividend growth, you probably are able to find some in the utility space right now. And that sends me into our trade application example, which does come from the utilities space. Let me go ahead and pull up, first of all, I'm going to pull up just a normal market forecast 1 grid, chart 4A here, and I'm going to pull up ticker symbol SRE. This is Sempra Energy. This is despite the name of energy in it, it actually doesn't even have that apparently. It's maybe it clipped that out of its name here years ago, but I always think of it as Sempra Energy. But it is a utility company. It's not an energy stock like Chevron or Exxon. This is a utility company that I used to pay bills to, as a matter of fact, when I lived in San Diego for about 5 years, and Sempra is one of the big utility providers down there. Anyway, you can see that they've gotten clobbered along with the other utility stocks here recently, and has produced a signal known as an oversold cluster signal using this market forecast technical indicator that drives these conversations in this video. So we've had 2 straight days of these little green dots showing up here down below and also showing up here on the chart up above. And what that signifies is an oversold cluster signal where the blue line, the red line, and the green line on the market forecast technical indicator are all in the low reversal zone on the same day. And the low reversal zone starts at 20. So those days when all 3 of those lines are there, that's going to suggest an oversold condition. You can see that we have had 1 instance of that here in the last 3 months. Back here on July 22nd, we also had these green dots appearing, suggesting that we had an oversold cluster signal. And that occurred on this candle over here. And you can see that in the immediate week after that, we had a nice reversion to the mean rally. We were up 3 out of the next 4 days. So perhaps we're about due for one of those types of moves here on Sempra Energy. We shall see. But just a reminder that those are fairly rare signals when we get oversold conditions like that. And oftentimes they kind of suggest that a bottom may not be exactly right there, but it might be in the neighborhood of forming a bottom because too many traders are on one side of the coin. Everybody's selling this right now, and therefore the market makers might try to push it in the opposite direction to kind of frustrate the traders and then also balance out their own books. And so that is the signal that exists right now with Sempra Energy. Now, like I mentioned before, Sempra is one of lots and lots of companies in all likelihood that are going to show up in the email tonight in terms of oversold cluster signals. So part of the other reason that I get excited about these types of situations is combining my knowledge of dividend growth investing with this technical indicator known as the market forecast. What I mean by that is if I come over here to the dividend stair-step chart now, what I use in my Monday afternoon options for long-term investors class and also my Tuesday morning dividend growth investing class, you can see that if I pull up ticker symbol SRE, that we have now come into this blue zone of the chart. And this is a company that my classes have had some exposure to in the past, and we've generally done reasonably well with ourselves. The basic idea here, without going into a long tutorial on it, is just understand that the blue area of the chart is where we would perceive a stock to be attractive based upon its own yield history. So each stock has its own unique yield history. And for Sempra Energy, traditionally, when it's yielding about 3.53%, it's viewed as an attractive longer-term setup for those of you that are willing to kind of think in those terms. And so you can see in the past, anytime it's been down here in this blue zone, like it was back here, 2011, 2012, then it touched the blue zone again right here in 2018, and then it did so with a lot of companies during the coronavirus era in 2020, and now once again right here, you can ask yourself a basic question. Had you been an investor picking up shares of SRE every time it touched the blue zone in the past decade. Will you be happy about that today? And I'd say generally speaking, most people would be reasonably pleased with that. Remember that these stair-step functions that you see on the chart here basically signify that this company has raised its dividend every year along the way as well. And their streak goes back nearly 2 decades in terms of their willingness to send more and more money towards their shareholders every year as a dividend growth company. So what I opted to do with today's trade application example is, just like a week ago when I did it with Clorox, I sold a put on Sempra Energy as a way to try to access this company at a discounted rate if we continue to see the stock market fall in the coming couple of months. I sold the November, I think it was the 115 strike, which you can see is about right here where my crosshairs are on the chart. You can also see that that lines up very nicely with a lot of horizontal support from the prior year. A lot of these other candles stop right around 115. And so maybe there is a bigger institutional buyer right around that level that can help protect our trade a little bit there as well. So for those of you that are newer to the idea of selling puts as a way to buy a discounted stock, remember, you get a benefit up front. We took in like $150 today for our willingness to buy this stock if it comes down to 115 here in the November expiration cycle. If that happens, you have to be willing to buy the stock. So that's the downside of it, right? The upside is if this stock doesn't get all the way down to 115, then your immediate credit that you took in today is yours free and clear to keep and do whatever you want with. And if it does come to 115, many of you would view this as an attractive utility stock to pick up for your dividend growth investing portfolio for the long term, because at that point, its dividend yield would be, well in excess of, let's call it like 3.75%. In other words, it'd be well above where we're at today at above 3.5%. It might not quite be to 4%, but it'd be probably in that neighborhood. So many of you might view this company that hardly ever has a 4% yield as an attractive pickup for the long term if it does get down to that general range. So that's kind of the idea there, is to take advantage of a spike in volatility. Remember, the VIX spiked today, as is often the case when we have a big down move in the market. The VIX was up 23% today, or 4 points, however you want to think about that, up to 23. And oftentimes when we have these spikes up, they basically give that back very quickly. It's probably a little bit easier to look at this on a daily candle chart. So let's look at the VIX on a daily candle chart real quick, and I'll show you what I mean. Like, even here in the last 3 months, we had this spike in the VIX back here in July. It was immediately unwound in the coming days. We had another spike in the VIX in the middle of August. It was immediately unwound within a couple of days. And then we had another spike in the VIX just last week, and it was immediately unwound by the end of last week. Here's another spike in the VIX that we're dealing with right now. And if you're somebody that trains yourself to sell premium on days when the VIX spikes, it generally has benefited you in the past once that spike has come back in a few days later. So it's kind of a sneaky way to have a slightly better trade setup that not a lot of people are thinking about, but that does benefit your trades, especially those sold puts, in situations where you're willing to own the underlying merchandise, like some of you might be with Sempra. Okay, so that's the idea. Again, all of you premium members will know that the trade's already been done. I've sent out the strike prices and the execution prices and all that via our Telegram app that you have all that advantage of during the trading day, and then everybody else that watches the free video gets that knowledge on the YouTube video overnight. So anyway, hope you enjoyed the analysis today. A little bit longer, but of course I think it was warranted. Today was a big day in the market. Was it disastrous? No, it was not. Was it a little bit painful? Yes, it was the 5th time in the last year that we've had a 2% sell-off day, so it was a bit abnormal from that perspective. But is it unheard of? Absolutely not. This happens regularly throughout history. If you don't get used to it now, you'll have to at some point in the future, so you might as well just get comfortable with the idea that yes, the stock market does fall 2% quite regularly, and it oftentimes presents an opportunity for you to look for beaten up merchandise, and that's exactly what we tried to do here today with Sempra Energy. So if you got value out of tonight's video, I ask one and only one thing from you, very simple. just click like for us there on Twitter. If you don't want us to do the videos in the future, then of course you don't have to click anything. But for those of you that want to keep these videos rolling, then that's the only thing we require out of you. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.